The U.S. economy lost jobs in July. Payrolls came in at minus 23,000, the first monthly decline since December 2020. That same afternoon, the S&P 500 closed at an all-time high.
Both of those are true, and they fit together more easily than they look. The market read a weakening labor market as removing the case for higher rates and repriced accordingly.
So we want to do three things today. Walk through what was actually in the jobs report, set out where the expectation of tighter policy came from and how it has been coming apart, and then look at the part of the tape that had nothing to do with the Fed, because optical networking had its biggest day of this cycle, and we think we know why.
The number that settles the rate question isn't Fridays, it's Wednesdays. Quick note, this is education and entertainment, not investment advice. Companies are examples. Never buy or sell calls. Do your own research.
Everything was green. The S&P 500 closed at 7,757.64, up 0.62%, a record close. The Nasdaq Composite finished at 26,690.62, up 1.3%.
The Dow closed at 54,036.93, up 0.28%. The Russell 2000 closed at 30,034.49, up 1.1%. Small caps leading, which is what you would expect if the market is pricing easier policy. The VIX sat at 14.90.
In bonds, the 10-year Treasury closed at 4.65%, down 4 basis points on the day. But the more useful detail is where Friday's move was concentrated. The 2-year fell 6 basis points, the 10-year 4, and the 30-year only 3.
So Friday's move sat at the front end. The part of the curve that tracks policy moved most, and the long end barely budged. If this were a growth scare, you would expect the long end to rally too. It didn't. What got repriced on the day was the policy path, not the economy's long-run outlook.
On commodities, we want to name the contract because the two gold numbers are unusually far apart right now. COMEX gold futures settled around $4,401. Spot gold was nearer $4,340. That is a gap of about $60. So if you check a quote tonight, you may see a different number than the one we just said.
WTI crude was $77.15, roughly flat, and the dollar index closed at 99.61, down 0.36%.
So let's go inside the report. Headline payrolls were minus 23,000 against a consensus near positive 83,000. That is an outright contraction, and it is the first monthly decline since December 2020. There was not a single negative print in 2021 through 2025.
The unemployment rate fell to 4.1% from 4.2%. Participation also fell to 61.4%, a 5-year low. So the rate improved because the labor force shrank, not because hiring picked up. Both of those figures come from the same release.
Average hourly earnings grew 3.2% year over year, the slowest since May 2021. The most recent CPI print for June was 3.5% headline year over year. So real wages are running around minus 0.3%, slightly negative. And May and June were revised down by 103,000 jobs combined.
Read together. That is a labor market losing momentum. Our reading is straightforward. It takes the case for tightening off the table for now.
There is a qualifier that has to go on that, and it is the 2026 World Cup hosted here in North America. Goldman estimated the tournament added roughly 40,000 jobs to the June payroll report, with hospitality hiring up about 9.5% that month. In the 11 U.S. host cities, leisure and hospitality employment fell only 1.2% year on year, against 3.5% everywhere else.
Then the tournament ended. In July, leisure and hospitality shed 40,000 jobs, and local government education shed another 50,000. Those two categories alone more than account for the entire minus 23,000 headline, which means the rest of the economy added jobs.
We don't want to flip that into a positive story, though. 3 things in this report are not sector effects. The 103,000 of downward revisions, participation at a 5-year low, and the direction of the trend. None of those are football.
So the headline is worse than the economy, and the trend is about as weak as it looks. Both of those hold at the same time.
Which brings us to the rate question. It is worth being precise about where the expectation of tighter policy actually came from, because it did not come from any one person.
It came from the Fed's own projections. At the June meeting, the committee held rates at 3.50 to 3.75%, but the summary of economic projections moved sharply. The median dot for the end of 2026 went to 3.8%, up from 3.4% in March. That median sits above the top of the current range. It implies a hike, not a cut.
And the distribution was clear. Of the 18 officials who submitted projections, 9 saw higher rates by year-end, 1 at 75 basis points, 5 at 50, 3 at 25. 8 saw no change. 1 saw a cut.
So when the market priced a hike, it had a documented reason to.
Then came the July meeting on the 29th. The Fed held again. The vote was 9-3, with Hammack, Kashgari, and Logan dissenting in favor of a 25 basis point increase, the most hawkish dissent the committee has seen since 2016. Chair Warsh gave essentially no forward guidance, saying the committee would act as conditions required rather than signal a path in advance.
That is the sequence, and it matters. The hawkishness is real, and it is collective. It is in the dots and in 3 formal dissents. The statement itself closed the inflation paragraph with a sentence the Fed rarely uses. The committee will deliver price stability, but the hike that had been priced in did not arrive, and the market has been unwinding that premium ever since.
Friday accelerated an adjustment that was already running. September hike odds went from above 50% to about 42%. The next decision is September 16th.
One detail is worth holding on to. That same July statement said job gains had kept pace with the workforce and the unemployment rate had changed little. That was the committee's own read of the labor market on the 29th.
9 days later, payrolls came in at minus 23,000. Nobody misjudged anything. The ground moved after the statement was written. That is what the market spent Friday adjusting to.
And here's the part that survives all of it. Every hawkish argument on that committee rests on inflation. The dissenters cited inflation running above target, not employment.
Which is why Wednesday matters more than Friday did. July CPI is simply the number that speaks to it.
Normally, a weakening labor market does cool inflation with a lag. But look at what this report contained. Wages growing 3.2% against headline inflation at 3.5%.
That tells you weak labor is not producing disinflation yet. A contracting job market alongside 3.5% inflation has a name, and it isn't Goldilocks. It's stagflation. And that is the one environment in which a committee with 9 hawkish dots might raise rates into a weakening economy.
July CPI lands Wednesday, August 12th at 8:30 in the morning Eastern. That is the print the whole tightening case is built on.
If it comes in soft, Friday's repricing gets confirmed and the September question largely closes. If it comes in hot, you have a contracting labor market and an inflation problem at the same time, and that is a harder setup than anything priced today. Bold. On a one-day chart, the move looks like a surge. On a 6-month chart, it looks like a recovery, and we think the second frame is the more useful one.
The peak was about $5,318 on January 29th on a futures closing basis. From there, it fell to about $3,986 on July 16th. Roughly a 25% drawdown over 6 months. Then a 3-week base formed between about $4,010 and $4,147.
Now it is about $4,401. That is up 9.1% in 4 sessions, from $4,033.70 at Monday's close. And it still leaves gold about 17% below the January high.
One detail worth showing. Friday's intraday range was $4,230 to $4,371. Gold traded down to $4,230 during the session and bounced off it. That level is the midpoint of the whole breakout, and it was tested and held on day 1.
The easy read is that gold rose because the Fed won't hike. We don't think that is the mechanism. Gold isn't priced for a rate cut. It is priced for a central bank on a narrow path, and most ways off that path support the metal.
If there is no hike and inflation stays near 3.5%, real rates compress, and that is supportive. If they hike into contracting payrolls, you introduce policy error and recession risk, and that is also supportive after an initial drop on the move itself.
The path that isn't supportive is a clean, soft landing. Inflation back to 2% with jobs recovering. A minus 23,000 print with negative real wages makes that path narrower than it looked a week ago.
And underneath the rate story, there is a structural bid. The World Gold Council says central banks bought 288.9 tons in the second quarter, up 62% year-on-year, a record for the quarter, led by Poland and China.
Survey data lines up. 89% of reserve managers expect to add gold over the next 12 months, and 74% expect to reduce dollar exposure. Gold ETFs took in roughly $89 billion over the past year.
That is the sovereign debt thesis stated by the buyers themselves, and it doesn't depend on what happens Wednesday.
Now to the part of the tape that had nothing to do with the Fed. Optical networking had its biggest day of the cycle. Coherent closed at $379.13, up 13.4% on the day, and up 31.6% from Monday's close. Measured from the previous Friday, it is up 44%. So the window matters when you hear that number quoted.
Applied Optoelectronics closed at $135.63, up 9.2%. Lumentum closed at $890.17, up 6.2%, and is up 131% year-to-date. Lumentum reports Tuesday the 11th, Coherent Wednesday the 12th, both going into earnings on very large runs.
AOAI's quarter showed revenue of $191.9 million, up 86% year-over-year, with non-GAAP EPS of 6 cents against a consensus of 2 to 3. Capacity goes from roughly 200,000 units a month now to about 650,000 by the end of 2026 to about 930,000 by the end of 2027.
C-Time rose 26.6% Thursday on second quarter revenue, up 127%, with its data center segment up 181%. One caveat worth carrying. About $85 million of its next quarter guide comes from an acquisition that closed July 1st, so the organic beat is smaller than the headline.
Here is what we think is the most important idea of the day. I want to be careful with the sourcing, because this is reported rather than announced. Nvidia is reportedly considering cutting the memory on its next-generation Rubin Ultra accelerator, going from 12-high HBM4E at 288 gigabytes down to 8-high HBM4 at 192. That is a 33% reduction. It was carried by TrendForce on August 4th and by SemiAnalysis and others.
The reason is supply, not engineering. TrendForce expects DRAM to stay tight through 2027, with meaningful relief only arriving late 2027 into 2028.
So build the chain out loud. Less HBM per GPU means large models no longer fit on one card. That forces more partitioning and pipelining, which means more GPUs for the same throughput.
And more GPUs working the same problem creates far more traffic between cards, racks, and buildings. The interconnect becomes the binding constraint. A memory shortage doesn't reduce demand for AI hardware. It moves the bottleneck out of the memory stack and into the network.
That probably raises total GPU purchases, raises system cost of ownership, and makes the standard Vera Rubin the workhorse. It is also why Optical had its biggest day of the cycle in the same week. Memory names were falling apart. They are not opposite stories. One is causing the other.
Which raises the obvious follow-up. When does the memory shortage end? There is a reasonably specific answer, and it priced on July 27th.
Changsun Memory, CXMT, listed in Shanghai. It raised about $8.6 billion, rose 466% on debut, and finished at roughly a $487 billion market capitalization. It currently holds about 7.67% of global DRAM.
The proceeds are pointed at an HBM ramp in 2027 to 2028, the same window TrendForce gives for meaningful DRAM relief.
So the shape of it is this. Long-term supply contracts delayed the usual boom and bust cycle. They didn't cancel it. The capacity that ends the delay has now been funded, and it has a date attached.
For the interconnect argument we just made, that is the clock. The bottleneck sits in memory and pushes work into the network, and roughly 2 years out, new supply starts arriving to relieve it. That is the window the optical names are being priced into.
Reuters reports a draft FCC rule that would ban imports of new models of Chinese 800G and above optical transceivers from Zhongji Inolite and Eoptilink. Together, those two are more than 60% of the 800G plus market. China has issued a counter-warning.
We want to be explicit that this is a draft. There is no publication date and no effective date. It can be modified or dropped.
The part that gets less coverage is that Coherent and Lumentum still depend on Chinese indium phosphide to build their own products. China controls roughly 70% of global indium refining and imposed export controls in February 2025.
On pricing, we have a single source, and we'll flag it as such. 6-inch indium phosphide wafers going from about $1,400 to about $5,000 since those controls, roughly a 250% increase. Treat the exact figure as indicative rather than settled.
The structure is clear enough regardless. The US holds the choke point on finished modules. China holds it upstream on the substrate. The American companies that would win this ban buy their raw material from the country being banned.
Here's how someone is betting real money on it. On August 6th, Roundhill launched the Photonics and Optics ETF, ticker FLIGHT. It is deliberately concentrated, with about 97% of assets in the top 10.
The top 5 are Lumentum at 15.4%, Coherent 15.2%, Optical 14.6%, Zhongji Inolite 14.2%, and Sienna 13.7%. The Chinese names are held through total return swaps.
Optical and Zhongji are the two companies named in the draft rule. Together with the other Chinese names, roughly 47% of that portfolio is Chinese optical.
One reading is that the proposal is negotiating leverage against China's indium phosphide controls rather than a ban that lands. That is a view, not a fact, and it is the fund's obvious risk. If the draft is published and takes effect, about 47% of the portfolio is directly exposed.
Two ways of funding an AI build-out got priced a day apart this week. Alphabet raised $25 billion of debt across 10 tranches, 2-year out to 40-year. Orders came in around $115 billion, about 4.6 times covered, and the 2-year priced at just 60 basis points over. It funds CapEx of $195 to $205 billion this year.
Celestica priced roughly $3 billion of equity at $310 a share on Thursday and fell 13.3% that day, despite beating on earnings. It recovered about 1% on Friday.
Same build-out, 2 costs of capital. An investment-grade balance sheet finances AI with debt at 60 over. Everyone else pays in dilution, and the market charges them for it on the day.
What we take from that is that this build-out is not capital-constrained, but capital is discriminating, and the gap between who can fund cheaply and who cannot is widening.
Elsewhere today, Atlassian closed up 35%, Airbnb up 17%, Palantir up 10%. The trade desk fell 22% on earnings. Cameco rose 4%.
On Cameco, Westinghouse, which is 49% Cameco and 51% Brookfield Asset Management, filed a draft S1 on July 31st. One detail is worth stating precisely because it is often repeated as larger than it is. The U.S. government holds a warrant for equity equal to 20% of the IPO valuation, less the first $17.5 billion of prior cash distributions. At a $30 billion valuation, that is about $2.5 billion, roughly 8% of the equity, not 20% of a company.
3 things to watch next week. 1. July CPI, Wednesday at 8:30 Eastern. That is the number the rate question actually turns on.
2. Lumentum Tuesday, Coherent Wednesday. Both report into very large runs, and this cycle has repeatedly punished good results from extended stocks.
3. Whether the FCC draft becomes a published rule. Watch for a docket number, not a headline.
Wednesday's print is the one this week turns on. We'll see you then. That's a wrap. If this was useful, follow or subscribe for the next one, and tell us where we're wrong. Thanks for listening.